Good afternoon. Welcome to the final series in the MEST Africa webinar series. So far, we have been looking at Africa Startup Funding 101. And today, I'm excited to be leading the final discussion for today. Today, we are going to be looking at Ask an Investor. And we have just the right people to have the conversation with. I'll be introducing them in a bit. My name is Amisha Darifori. I am a proud MEST alumni and currently an innovation strategist and consultant with Innovation Spark. We help startups and investors find value from each other. Perfect. So today is day 3. If you haven't been able to join the webinar series, the series have been recorded and you can find them on MEST Africa's YouTube channel. Day 1 was a conversation with the panelists, one from Brightest Bridge Africa and Jack, who is also a VC. And they had a conversation on the insights on Africa's funding. Day 2, which was yesterday, was a conversation with an all-MEST panel. We had Paul Damali, who is the CEO and co-founder of Approve, and Henry Mascot from Curacell. And they had a conversation with Emmanuel Adoyenchi. This was a conversation with co-founders on how they have navigated the VC terrain. And today we are concluding it with a conversation with VCs. So if you've ever had a question for VCs that you've been dying to ask, today's session is perfect for you. I'm going to go ahead and introduce my panelists for today. First person is Ashwin. Ashwin Ravichandran is the current managing director of MEST and a very good friend. Ashwin is seasoned when it comes to helping startups talk to investors and vice versa. The next person on the panel is Lavanya Anand, and Lavanya is currently the principal at the VC called VestedWorld. Welcome, Lavanya. Welcome, Ashwin. Perfect. So let's just continue from where we left off the previous conversation. We have a slide deck from our first day that we weren't able to share with you. We'd like to share it now, just to get an idea of what is happening in the investment scene. So from our report from Brighter Bridges, we see that we have 85.6% funding coming from equity type funding. We have debt funding up to 13.7%, and the rest are all from awards, grants, crowdfunding, etc. So if we look at this graph, there's a lot of conversation to be had. What has influenced these graphs, and why are investors particularly going for this type of funding, which is perfect for our conversation for today. So I'm just going to segue straight into our conversation and find out from you, Lavanya. Do you think this chart we have is true for VestedWorld in the type of funding and investment that we've done?
Yeah, hi everyone. So VestedWorld, we are an equity venture capital fund. So we are investing primarily in equity and convertible notes. And so at least for the time being, our focus is, matches what's showing here on the pie chart. We are exploring the idea of possibly, providing venture debt or working capital facilities to our existing portfolio companies, but it's not something that we've done yet. But yeah, I would say, especially at the early stages, we typically come in at like pre-Series A or Series A stage, and most companies are not yet profitable and not yet necessarily at a level of scale where it makes sense for them to bring on a lot of debt. And so where we start to see more debt is probably, once you start to get to Series B and later, and you're approaching profitability, you have the more predictable cash flows to actually service that debt. Otherwise, I feel like at the earlier stages, sometimes it can be a bit of a burden to bring on debt and be liable for principal and interest payments when there's so many things that can go wrong at that early stage. However, there are some funds out there who are coming up with more creative solutions when it comes to venture debt, and things like having grace periods or more flexible terms, and aligned with the cycle of that business. So it might be related to their receivables or working capital cycles. So we are starting to see a bit more, but for us personally, we are focused on the equity side.
Great. And I want to refer to the conversation that was had just yesterday about the different fundings that the co-founders ideally like to go for. And one of the co-founders mentioned that you don't want to be giving off a lot of equity in the very beginning. So I'm curious to know, even though you're doing equity funding for these early stage startups, how is it like when it comes to the whole conversation about how much equity to give?
Yeah, it's a great question. I think it does somewhat depend on the business model and the sector. If you are a lending business, you probably don't want to use equity for your on lending capital. So then it may make sense to bring on a mix of debt and equity. I think here, though, it makes sense. In order to unlock debt, you often need equity. So it's a bit of a, there's very few instances where you're going to have debt but no equity. You may have debt and equity, but usually the equity comes first, especially if you're not yet profitable. But I do think you have to be careful about dilution, and I think here the conversation is really around what are your milestones. So you don't want to raise more capital than you necessarily need at that early stage. You want to raise just enough capital to prove out your top 3 milestones, which then allow you to raise additional capital at a higher valuation. So you want to maybe try to break out your business roadmap, in 6-month increments, let's say. Say, okay, how much do you need to get over this hump and show initial traction, so that you're not over diluting yourself very, very early on. But with that said, I also understand that fundraising takes a long time, and founders don't want to be doing that all the time. And so here it's maybe helpful to have co-founders where maybe one founder is focused more on the fundraising and strategy side, and then one founder is more focused on operations. So you can kind of balance that out, just the time commitment a bit better.
Okay, and actually, let me come to you. I know that MEST ideally helps the co-founders right from the school to when they enter the incubator. How has MEST influenced how much equity funding is done, especially for the co-founders that raise funds outside, the MEST Foundation itself?
Yeah, thank you for that. And I do agree with Lavanya. Like, I think there's a fine line between equity and debt in any sort of ecosystem. And if you look traditionally at private equity, they never invested 100% debt, right? They always do what is the equity to debt ratio over here. So I think at MEST right now, I think because also like we've sort of like metamorphosized into like a little bit more than just an investment agency right now. We've also like started getting a lot of donor funding, which usually cannot be equity. So we often have to give them out as grants. So if you look at our UNICEF Startup Labs, you look at the MasterCard Foundation Express programs, and you also look at, I think, the one we were running with Sanad, they were all focused on giving grants to people who actually finish the program, right? So at MEST, often we've realized that I think it depends on different business models. It also depends on what the founder's appetite is. Like for example, if you look at Paul, right? Paul was 100% sure that he didn't want to raise till he actually got that product market fit. Luckily, he had co-founders who had that appetite as well. Similarly, when I put Henry on the play, and Henry was always like, I want to raise, I want to raise, I want to raise, or I want to raise. But then he always figured out a way where he would apply for this grant, win it, then he could take the company forward, right? So then when he actually raised his big round earlier this year, it was a very credible round because he hadn't given away too much equity. They had hustled for 2.5 years. So at that time, MEST comes in to understand what the founder actually needs and lets them
Okay.
exist, make sure that they're getting the right support. Like for Henry, for example, we would always send him all the grant opportunities and help deck in Nigeria to basically look at, see if he's actually capable or not. Because again, the problem he was trying to solve was so big that it took him a long time to condense what was actually the problem, right? And I think with Paul also realized that the solution which he wanted to actually go in with was too small. So he had to build a more durable solution as well. So in that case, at MEST right now, I think it's a pretty much bespoke model. So if we get founders in who don't want to take investment or who we don't think are investment ready, there are other ways where if you're part of the community, you benefit either through other programs we're running for donors, or if we're figuring out a way where we can equity invest in you at a later stage as well.
Okay, that's brilliant. So what I'm hearing from you is one size doesn't fit all. You look at the different co-founders and startups and see what works for them. Let's go to these co-founders. Do you think that startups understand the investment life cycle and how it looks like? And if they don't, how best can you explain it to them?
Yeah, I think this is like a catch-22, right? Which was, I think, what Lavanya was speaking about. I don't think it's about just founders understanding investment life cycles, but it's also about investors understanding investment life cycles, right? Like, I think both Lavanya and me can comfortably say that we sat across deals where the founders are like, yeah, we promised to give you back 40% or 40x returns in 20 years. And we're like, how does that work, right? Or we've met founders who are like, Ashwin, we don't know what the returns can be. We want you to give us a deal and all of these things. So again, I think where we're sitting at right now, helping founders understand investment life cycle, I think depends on the market. I think 2021 has been a very, very interesting, I think ecosystem where we're seeing a lot of, I think, different deals come through. We're starting to see different tickets come through. So I think towards the end of the year, obviously with Britter and with Josh and with Dario, I think once we do a little bit more of a research on the ecosystem, I think we'll be able to talk about what actually fits. But I don't think the problem of investment lifecycle just lies on the founder side. It definitely lies on the investment side as well.
Yeah, and maybe just to add to that, I think it's important. Can you hear me?
Yes, go ahead, Lavanya.
Yeah, I was just saying, I think it's important for, in initial conversations between founders and investors, for founders to try to understand what is that particular investor's expectations, right? Because some investors may have a 10-year fund, some may have a 15-year fund, some may have a 5-year fund, right? And so maybe some investors, they want to come in at pre-seed or seed stage and exit via secondary sale by Series B, right? Whereas someone like us, we're coming in at Series A, we're not expecting to exit until 6 to 8 years down the road. So it really, I think it's important to set those expectations up front, because then you can also figure out which investors are aligned with the business model you're also trying to develop. So yeah, that life cycle and return expectations is very fluid and just really depends on which investor you're speaking to.
Okay, so let's continue from where you just left off, Lavanya. The type of investor will influence the life cycle. Do you think that investors who have had startup experience are able to better appreciate and understand where the co-founders are coming from, and so have a better deal structure as opposed to VCs who are just in the space but haven't had much of a startup experience?
I think so. It's hard to say. I mean, at least at VestedWorld, most of us don't have traditional startup experience previously, but I think we can be empathetic to founders. We've worked with enough portfolio companies over the years that we understand what they hate and what they don't hate. And so, we're also kind of constantly shaping how we think about investment structures and how we can be more creative. So I think it depends on your overall experience, whether it's in a startup or even in investing in startups. I think both can give you a lens of like what works, what doesn't work, what is market rate and standard versus what's not. But yeah, I mean, from what I've heard of investors who do have operating backgrounds, I think founders do like working with them because they kind of see them as as peers who can, who understand the struggle and where they've come from. So yeah, I think it just depends. But I think, definitely you want to kind of check with your lawyers on, is this investment structure friendly? Is it market rate? Is it standard? And if there's any terms that are not, then you want to make sure to push back on those. And I think slowly, depending on the sector, I think it's becoming it historically has been an investor's market in the sense that they've dictated terms, but I think more and more you're starting to see founders dictate terms, especially if it's in a trending sector or a high growth business. So yeah, leverage that where you can.
Yeah, thank you, Lavanya. How about you, Ashwin? What do you think? Lavanya has mentioned how either investors or startup co-founders can dictate their terms. You are sort of in the middle where you help the startup co-founders make these deals. So what have you noticed? Are there investors who are more sympathetic to co-founders, and who are these type of investors?
Again, I have multiple perspectives of this, and being a founder myself, I can tell you this: not every founder makes a great VC. That's number one.
Okay.
And similarly, not every investor makes a great founder, right? So often what I've realized in the past, and I think like successful models such as India and Singapore have proven it over and over again, is that you need both people on the table, right? And I think where we come from is that you need that deep skill knowledge to actually financially manage not only your money, but LP's money, because at the end of the day, investors rarely invest their own money. And for that, you need a particular type of skill set, which often founders don't have, right? Like to manage an LP is like to stroke a cat. Like it's very, very hard, and it's very, very difficult. While similarly on the founder side, I think what I've realized is that founders actually lack sometimes or not the long-term perspective of the system change. Like I think they're so siloed in what change their value chain can provide, rather than actually think about, oh my God, this is a portfolio-centric view, and this is how we can move things around to actually influence the ecosystem on the next perspective. So again, I don't think often or not a founder makes a great VC or a VC makes a great founder, etc. I think if both people come onto the table to actually understand what I think the investor has to portray to their LPs to make sure the deal can actually go through, and if the investor is a little bit more forthcoming, like for us, it's very simple. Yon's our investor, so I know how to manage him. I know what he wants, so it's often very easy to dictate the terms of the deal. But often or not, I don't think it's the case for many people who actually have multiple LPs. And similarly, being a founder, I'm able to bring a lot of the founder challenges onto the table. But often or not, I've also seen that great investors are able to empathize, and they're able to actually figure out what are the different challenges based on legacy and trend as well. Like VCs do not just randomly come in and start spraying money, right? Like they've understood the ecosystem, they've understood founders, their motivation. So yeah, I think it's a good mixture of everything, rather than just saying that, oh, founder will make a great VC, or oh, only the VCs know how to do their job.
Okay, great. Then baseline, have that conversation, establish whatever you want to agree on, and don't really care about whether or not you as a founder. And speaking of empathy, I've noticed that globally there are companies like Uber, TikTok, Amazon that didn't make profit in a long time, but went on to become unicorns, Centos worth over 100 billion valuation. Is this something that happens in Africa? Do we have patient capital to make this type of growth possible along these lines of empathetic VC?
Yeah, I'll be really honest. While all of these people didn't focus on revenue, they focused on the other metric, which is very important for investors to look at, which is the user, right? Like, for example, it's as simple as that. Like, TikTok did not become big just by having 20 users who had maximum interaction. They had a virality component, same thing with Uber, same thing with all of the big, I think, unicorns we actually compare ourselves to. So again, while if a business has a very, very clear focus on users, right? So I can give you a few examples. Okay. Like, for example, Farmerline, right? Alloy has existed in the ecosystem for over 8 years. We know that he's always raising money. We always know that he needs more money. He wants to think. Yeah. But the single point of focus of his success has been that he never loses focus of the farmer, right? At the end of the day, all his campaigns, all of his design, all of his sales, they're all structured around that. And because many people can see that he's going down that path, a lot of people want to put in patient capital with him. So again, I think it depends on the sector. I think it depends on that. I think it depends on, the ecosystem where it is. But as long as your business is showcasing that the user is growing within your product or within your own service or within your own business, I think there's a lot of patient capital currently available in the market. As long as you can put the narrative in this perspective, saying that today CAC is 12, tomorrow it'll become 10, day after tomorrow it'll become 2. But at the end of the day, we really show that that is happening rather than saying, oh, I'm a user-centric business. I just need your money because I just want to keep testing. I think that doesn't work anymore on the continent.
Okay, Lavanya, do you want to comment on this? You being an investor, do you have patient capital?
Yeah, no, it's a great question. So we traditionally, do like to see revenue traction in businesses before we feel comfortable investing, but I think that's just because of our investment lens and our kind of risk appetite. Because for us, product market fit is a strong indicator of future success. So we like to see, how is the company actually going to make money? How does that translate? So if you put in $500,000, what is the output going to be? We want to be able to kind of predict from a financial modeling standpoint the trajectory of the business. With that said, there's lots of investors, especially at the pre-seed and seed stage, who are willing to come in to businesses that are pre-revenue and have the potential. I think for those businesses, like Ashwin was saying, the story and the vision is really important. I think you can sell it, if you have the ability to sell a story. I think there's a lot of there's a lot of capital and decent valuations to be had. So take, for example, Kuda Bank in Nigeria. They have recently raised at like a 500 million plus valuation. And it was this whole user story where they, I think, had like 1 million downloads, but they hadn't necessarily unlocked the potential of those up to million users. Okay. But now they have started to unlock that potential. And I think those early investors saw that, right? They said, okay, it's not just an idea. We know how this company can make money if they have loyal users who are, who are being retained month over month. Now it's just about unlocking the revenue potential. But it's not like you're testing out a product or service that has never been done before. It's still a banking service, so there's demand for banking products. So you're not revolutionizing necessarily the product or service. It's just more the delivery of that service. And they decided to invest first in user acquisition and then raise the capital to then now unlock that revenue potential, which you'll probably start to see relatively soon. So yeah, I think it just depends. I do think there's investors out there who want to be told that story and the vision. And but yeah, that doesn't mean you can't have a strategy for how you will make money. You have to be convincing about your monetization. But I don't think that monetization necessarily needs to be in place at the time of an investment.
Okay, thank you, Lavanya. I want to come to you. Let's continue from here. So help us to understand, right, at VestedWorld, what's a typical investment decision cycle like at VestedWorld, and how many times do co-founders have to pitch to you? How many times do you have to see them, due diligence, etc.? Can you walk us through your process?
Yeah, sure. So in any given year, we're probably seeing at least 300 to 400 companies come through our pipeline. We're relatively sector agnostic, so that increases the size of our deal flow in our pipeline. But yeah, historically, we've made probably 5 investments per year. So you can imagine it's not an easy process to go from a few hundred companies down to 5 companies in a year. So we have a funnel process where we're reviewing an initial pitch deck. We usually we'll do an initial review based on the pitch deck and say, okay, do we recommend having a conversation with this company? Do we think it's a pass, et cetera? For those that are interesting enough to have a conversation, we'll set up that call. I'd say, yeah, so that's probably the initial like pitch that the company does, but it's more of a conversation, right? And then based on that conversation, we decide, okay, do we want to have follow-up conversations with this company? Are they at the right stage for us to potentially invest in? And if the answer is yes, then we request some materials. We may have a follow-up conversation to get additional information. And basically, you know, we just work our way down that funnel. So then in any given year, we have a two-stage process. The first stage is what we call a screening, and then the second phase is due diligence. So for that first screening phase, that's, you know, when we're having those early conversations with founders, maybe asking for a pitch deck, a financial model, and some high-level materials. And then we decide if we want to move forward based on that information into due diligence. So we have our first kind of gate where we get feedback from our investment committee on whether we should move into due diligence. Once we've gotten that initial go ahead to move into due diligence, then it's usually maybe like a 6 to 8 week process of more in-depth diligence where we're talking to customers, doing site visits, talking to other team members, and, you know, basically developing an investment recommendation on the opportunity. Then we go back to our investment committee for a final decision to make that investment, and then we can disperse shortly after. So I'd say the phase that has more variability is that first phase, because it really depends on, you know, the founder may not be fundraising actively at the time that we have that introductory call. Maybe they're going to launch their fundraise in 2 months, or maybe they're still a bit early for us, so maybe we revisit in 6 months. So that's the phase that has more variability, because we're seeing so many companies and we have to like really think about our capacity and priorities, and to decide which ones we want to move into due diligence. Once we're in due diligence, it's a much more structured process where we can say, you know, in X number of weeks, we will have a decision for you. So on average, I'd say historically, our investment process from start to finish has been like 3 to 6 months. We are actively trying to make that shorter, so closer to like that 3 month time frame. And then, you know, with our new fund, we're actually creating an allocation for, you know, pre-seed and seed stage investments as well, more on an opportunistic basis. And for those, you know, we're targeting like a 1 month cycle. So not as extensive due diligence as what we would do for, you know, a typical Series A stage company. Hopefully that helps.
Thank you for that insight, Lavanya. If you are just joining us, this is day 3 of the MEST Africa webinar series. We have been looking at Africa Startup Funding 101. Today, we are talking about Ask an Investor. My name is Amisha Dayofori. I'm your host, and I'm speaking with Lavanya, and she is the principal at VestedWorld, and Ashwin Ravichandran, who is the managing director at MEST Entrepreneurial School of Technology. We have spent 30 minutes on our webinar so far. I want to take a breather. We are going to put up a poll. Feel free to answer in the next 30 seconds quickly, and then we'll come back and do a Q&A where you can ask the investors all the questions you need. So the poll is up. When do you think it's a good time to engage investors? Quickly, in the next 30 seconds, let's do this. When do you think it's a good time to engage investors?
I can't believe we can't vote.
You are the investor. You will give your answer soon. Okay, so we have 15 seconds left. 10, 9, 8, 7, 3, 2, 1. Perfect. Okay, so we'll collect the polls and share them with you by the end of the session. Now we want to give you the opportunity to ask all the questions that have plagued you since you started your company. We have Ivana here to answer your questions from the perspective of a VC, and Ashwin, who has been both a co-founder and now is dealing directly with investors to answer your questions. So I'm going to go to our chat. Put your questions in the chat session and we'll read them out. For the sake of time, we won't be able to allow you to ask your questions. So let's go to the chat session and let's see what kind of questions that you have. And whilst we are waiting, one of my questions, Ivania, was based on how steep your funnel is, your very narrow funnel. what advice would you give to founders who are applying for investment from VestedWorld? What would make them move from the 400 to the 5 or so startups that you're able to choose?
Yeah, that's a tough one. I think, first of all, I recommend that founders do research on investors before kind of building up their pipeline. So understanding, who's a good fit based on previous investments that they've made, so that you're also being efficient with your time. So, for us, we have certain sectors that we've invested in and that we, certain business models that we like to fund. So that can help in making that process a bit smoother. Our average check size is 500,000 USD. So, if you're raising 100K or 200K, you're probably not an ideal fit for us yet. Separately, I think referrals help a lot. So if we're hearing about you maybe through another investor who is already invested or is looking at you, then that usually comes, might be a higher priority fit for us versus maybe someone who's cold outreaching on LinkedIn. So if there's a way to get a warm intro, I think that usually helps. And yeah, I think just obviously, the numbers and growth are kind of obvious ways to get an investor's attention. And, I think also there's this aspect of creating like a FOMO effect, where, you want to position your company and your investment as the next, hot deal that you don't want to miss out on. And you want to try to get investors to look at you at the same time and almost compete with each other to raise funding, right? So that requires a bit of coordination and a bit of kind of salesmanship. But I think if you can, express that, there's other investors looking at us right now too. These people have already committed. We're hoping to close a round in the next 4 weeks. You try to create this urgency and this FOMO, like I mentioned. I think that can get investors to move a bit more quickly, because then they might fear that if they wait until the next round, maybe the valuation will be too high. And you want to make them think that they need to come in this round if they want access to the opportunity.
Okay, so it's a combination of different things. Apart from the traction, you have to make sure that you're also working on the soft skills as well. Thank you, Lavanya. Let's go to the Q&A session. Enoch Insia wants to know if sole founders are likely to secure seed investment in their MVP stage before bringing on new teammates. So if he's solo, can he raise money before bringing on teammates? Anyone can take this answer. Ashwin, maybe you go first.
Can you repeat the question, Amish? It's like a little hard to hear you.
He wants to know, right? Enoch Insia wants to know, he's a solo founder. Can he raise money before bringing on teammates?
Yeah, so again, from a MEST thesis perspective, we usually don't invest in single founders. I think different VCs have, different theses around founders. But for us, from where we sit at right now, we have seen that, yes, being a single founder, you can't raise money. But the problem you're trying to solve, you need to have the necessary experience, expertise, and probably years of experience before people actually take you seriously, right? So in that case, having a team at that time actually brings about that experience to a cumulative level. So in that case, I would ideally advise to try to find a co-founder, which also shows that you're able to build, vision creation and vision basically like sort of collaboration early enough. Being a single founder, I think, has a lot of challenges, not just raising money, but other things as well. So.
Okay. And Israel, into me, wants to know, what does a startup need to prepare to engage investors? Lavanya, maybe you can take this one.
So I imagine at the earliest stage, kind of what are investors going to look for? Yeah, it's a great question. I think if you're a pre-seed company, the expectations are going to be very different than if you're, a slightly later stage company. So I do think you need some kind of, business model in place. You have to have done some level of market research to identify what is the problem that you're trying to solve and have an understanding of what the pain points are and why your proposed solution will address those problems. And it has to probably be a large enough market opportunity that there's a scalable business here, so less niche, I would say. And then, and then having at least, a couple team members around you who are kind of building together and a plan and some kind of roadmap for how you plan on rolling out the product, how you plan on going to market, having an understanding of what are the key hires you would bring on as soon as you do have capital. So knowing what are your priorities in terms of if you're raising X amount, how will it be used? And then validating that there is a problem to be solved and that, your idea or prototype MVP for the solution is a viable way to solve that problem.
Okay, thank you, Lavanya. And Kojoaka wants to know, what does profitability look like for VCs in terms of numbers? I'm sure this will be varying, but Lavanya, from your point, what does profitability look like for you as a VC in terms of numbers?
Yeah, typically, we're not expecting companies to be profitable at the stage at which we invest. I'd say most companies are probably not approaching profitability until like earliest Series B. So that's, when you're probably doing multi-million dollars in annual revenues, when you're probably starting to actually become profitable. Obviously, it depends on the sector. I think if you're a more traditional sector, like in agriculture or in, like a more brick and mortar type of business, then I think the expectation might be to become profitable sooner, because here, the way an investor is going to exit is based on a multiple of your profits or your EBITDA, right? Versus a tech business, you're able to sell your stake in a business, not necessarily based on profitability, but rather on growth. So it also depends on which sector you're in. But yeah, at the early stages, I don't think there's an expectation around profitability. I think where you should maybe focus is on unit economics. So what is your gross profit for delivering your product or service? Do you have positive unit economics that you can then scale up as you invest more money into the business?
Okay, so I hope you got your answer there, Kojo. Dimitri wants to know, this is to any of you, do you typically take board seats in startups? What if there isn't a board?
Yeah, I would say we take board seats in like 60-70% of the companies we invest in, or at least an observer seat. When there is not a board, then we propose the creation of a board, at the very least like an advisory board. So oftentimes it's a bit tricky. So when you're at an early stage, your founder, your investors might be coming in on a SAFE or on a convertible note, so they're not actually shareholders in the business yet. So in those cases, it might make sense to have those investors have observer seats as opposed to a formal board seat, just because there's a little bit of conflict of interest when you're not yet a shareholder. But then upon conversion into from your note to equity, then we typically convert that observer seat into a formal board seat. But in the meantime, we help companies set up that governance structure and get into the cadence at least of having regular board meetings functioning as a typical board would, even if you don't have necessarily the same, the formal voting structures that you might have at Series A and beyond. But yeah, I think that governance is quite important for building trust and accountability, and kind of setting yourself up for a successful Series A fundraise.
Yes, and that's a conversation that came up in the earlier series of last 2 days. Ashwin, how about you? Apart from MEST funded companies, does MEST or Mel Total Foundation have any board seats on other companies?
Yeah, so because of the typically the stage we come in and typically the sort of advice we need to give to our companies, we try to take a board seat. And again, we're more than happy to relinquish the board seat as and when the rounds increase. But because then companies often are not and founders often or not require a neutral agency, especially at that stage, we often come in. So there has been, I think, very good examples of when either investors have tried to screw over the founders or the founders themselves are trying to screw over the other founders, where having a board member who is very unbiased towards the founder, but is very focused on making sure the business succeeds. I think having a board member there is very critical. And again, because of the position of MEST where we sit in, we just don't do cash, right? We help the companies grow. We're a company builder. Plus, we provide companies talent, etc. as well. I think being part of a board actually gives us that confidence and gives other investors confidence as well. Like I know for a fact that there's so many companies who even Lavanya has spoken to, because she knows that we sit on the board or we have actually invested in the company, and similarly other investors in the ecosystem as well. So because of where we sit in typically early stage tickets anywhere between 25 to 250K, I think it's healthy to have us on the board.
Okay. Dimitri Opoku and Isaac Aqua have a similar question. Apart from money, what value do VCs provide? So Ashwin, you can go first for this one. And then...
Yeah, that's a very good question, and I think I think people keep forgetting that we're human beings too, and your growth is dependent on our growth, and our growth is dependent on your growth, right? So again, VCs basically come on to basically provide the end-to-end spectrum. I'm speaking for VCs who I know, such as VestedWorld, such as basically Timon Cap, such as even MEST, for example. I think we're all VCs who are very active in our companies. We're trying to solve problems with them rather than for them. And we're also typically trying to be a little bit more hands-on, right? So again, VCs just besides providing, I think, investment gives you, I think, four things. One is obviously exposure to other VCs. Two is definitely making sure that the company doesn't go down from a lot of different perspectives. The third thing is obviously to help solve problems with you rather than for you. And finally, I think the big thing over here is making sure that I think the sort of like talent play within the company is also done by the VC, not just by the company.
How about you, Ivania? What else do the VCs bring to the table?
Yeah, I think a lot of what Ashwin said, but I think it's really helpful to have a sounding board as a founder. Oftentimes at the early stages, you are sucked into the weeds of the business, even though you maybe want to be high level. But I think the VC's job is to help you think high level, right? Because they see the big picture, even if you're maybe in the weeds. And so I think where we try to support is things like strategic planning. What is the overarching mission and vision of the business? What should the budget look like for the next year? How should we be thinking about our 3-year roadmap or 5-year roadmap? And just providing that support where the company needs us, right? Like I said, we do take board seats. So that also comes with like supporting with subsequent fundraisers, helping with financial planning where it makes sense. So, I've helped build financial models for some of our companies, or helping put together an investor pipeline or a data room for a subsequent fundraise, and also opening up our network. So we have other investors in our network, but we also have other, strategics or advisors or potential clients in our networks that we can connect companies to. But yeah, we try not to get involved in the day-to-day operations of the business because it doesn't feel like the right space for us. But I think it's helpful. I think one more thing to add is that VCs typically have lots of portfolio companies, right? And so I think leveraging the learnings from other portfolio companies is also quite important. So we might be paying attention to certain market trends that the founder is not aware of, and we can share that information back with them or connect them with other founders who maybe have gone through a similar experience. That sort of thing, I think, is one of the big advantages.
Oh, alrighty. So that's definitely way more than just giving money. Thank you for the additional value add. One more question from Mohammed. Mohammed wants to know what makes investors decide to invest at the ideation stage. Ashwin, maybe you can come in for this one, and then Ivania, if you have any other, you can add. So, what makes investors decide to invest at the ideation stage?
So in the past, I think when we've invested in Ideation, stage companies, there's been two very, very, very big factors of investing in companies. One is having a team which showcases that experience as they've either done it in the past, failed, or they've succeeded, right? And they're able to bring about that sort of energy to the table all over again. The second thing, which actually really this thing, and I think Lavanya spoke about it, is more about the FOMO, right? Like if you look at all of I think the 10 companies in Nigeria raising, they're all raising with each other as a reference. They're not using any other metric across the world to actually do it. So if you look at Kudi, VBank, look at all of them, they've all raised money basically using them as a reference point. And I remember when I think we got Kuda's deck back in 2018. It was an idea, man, and he was going through all his licensing processes and everything, right? And he was literally using Paystack, Flutterwave, and he was using, I think at that time, VBank as his reference point, saying that if people are investing so much money in them, why aren't you investing in me? And similarly, he was able to raise his $1.3 million round, actually now scaled across, just raised a $50 million round as well. So again, I think it's the experience and definitely the FOMO, which you can create as a founder, I think, to the other investors.
Okay, Lavanya, similar thoughts, or do you have any opposing ideas?
Yeah, no, similar thoughts. I think just, creating the FOMO, having a strong idea, strong operating background, and, leveraging angel investors at those early stages to the extent possible because they can move more quickly. So angel investors, and then there's specific pre-seed type of funds who are very risk tolerant, right? And so if you can show buy-in from some of those, risk tolerant investors, then it makes it easier to now raise from institutional capital, because for institutions now, the investment has been slightly de-risked because you've already brought in a little bit of capital into the door.
Okay, perfect. We have 3 more questions. Samuel Asante wants to know, what do you invest? Okay, we sort of tackled this one. Investors, what do they look out for from startups? Elizabeth wants to know if we can talk about angel investments. So for pre-seed and early stage founders, what are the standard conditions for investments? I think we've mentioned this a bit as well, but if you have any additional answers to that, angel investment, pre-seed, what are some of the things that are highlighted?
I can go for this. So I just recently started making angel investments on the continent. So I think I've had a fair share of experience, I think, with bad term sheets and good term sheets. I think with where I'm sitting at right now for an angel investor, to protect yourself, and again, I think to make sure that you guys are being credible, one of the first things which I've often seen is anti-dilutive shares for angel investors. Like I've seen this so much right now that I think it's such a bottleneck on the ecosystem that an angel investor doesn't want to dilute his shares or her shares, which is like, dude, like it doesn't, the math doesn't add up. And I think I know some angels, and I'm pretty sure Lavanya knows as well, that they're so aggressive right now that it's building a bad ecosystem vibe, right? Like people are starting to sideline them. The second thing which I will often go for also with angel investment is try to make sure the valuation at that time is not very, very high. One of the big things about angel investors who really want to come in, like I've angel invested in a company called Quilly. Like the biggest thing over here is not about the money, but it's actually about the time being spent with these guys, right? And that is actually not, I think you can't remunerate that. So from that angle, to have a healthy mix of cash plus sweat for an angel investor, because at the end of the day, angel investor is some sort of a late stage founder into your business, but a founder who has money, right? So I think in that case, trying to understand the balance between, is this person actually giving you cash, or is this person actually bringing you sweat? Thereby, it combines those things as well, and that affects the valuation. So I think those two things are like the biggest for me right now, is that one is don't serve a bad term sheet, understand the deals of the term sheet very, very well. And the second thing is to make sure the valuation is not too high, because no angel investor is coming at that time to see his money or her money double, but actually see the business grow.
Perfect. Thank you, Ashwin. And Isaac wants to know, is it better to focus on growth within home markets that's owning more of the pie in the country, or to focus on geographical expansion, having a wider market to grow in? Which one is better? Or is there a reason to focus on any of it?
Yeah, I think it depends on the sector again. So if you're, and which market you're in. So if you're starting in Nigeria, there's probably a lot of room to grow, for example, versus if you're starting in Rwanda, it's a more limited market size. And so if I'm an investor looking at a company in Nigeria, I'm going to say, why are you focusing? And they're trying to expand quickly, but they're, haven't found product market fit in Nigeria yet. I would question, why are you trying to expand before you've found product market fit in your initial market and there's plenty of room to grow? Versus, like I said, if you're in Rwanda, you're using that as a proof of concept or a pilot, then it makes sense to quickly expand into Kenya or Tanzania or Uganda, because you want to also show to investors that there's a large enough market available for your product or service. So yeah, and then you also want to think about, okay, like which markets are most similar to your initial market, right? So expanding to a market that's very different may not be advisable because there might be a different regulatory environment. There might be, customer behavior might look different. The model in one may not work the same as in another country. So I think you shouldn't just expand arbitrarily. It should be a well thought out decision as to why, you should be kind of looking at what are the key criteria that makes a good market, and then doing the research to find out which markets those are, right? So it may not be the neighboring market, it might be across the continent. But yeah, you should be able to justify why you feel like you need to expand into that next market.
Okay, so let's just take a breather and refresh the room and say that this is day 3 of the MEST Africa webinar series. We have been looking at Africa Startup Funding 101. Today's session has been Ask an Investor, and we are speaking with Lavanya from VestedWorld, and Ashwin, who's the Managing Director at MEST. We'll take one more question before we round up. Someone wants to know, Hussein Mushi wants to know, can an investor invest in a company which has not started to make profit yet?
Typically, most companies in our books don't make money. But again, I think there's a difference between revenue and there's a difference between profit. I think where we sit at, we probably expect companies to be a little bit more revenue centric rather than actually be profit centric. Like, we understand that profit at the end of the day is very subjective. But where we sit at today, yes, we do invest in companies which obviously don't make money for the various reasons. But if you have revenue and a focus, and if you can show that there's a few customers already starting to pay, I think it makes more sense.
Your answer makes sense as well, Ashwin. So be more revenue focused so that eventually you become a profitable company. That's a good answer. Thank you, Ashwin. Lavanya, how about you? Does VestedWorld invest in companies that are not making profits yet?
Yeah, definitely. Like I mentioned earlier, we're not expecting companies to make profit. Earliest is probably Series B for tech companies at least. So at the early stages, I would focus on growth. Obviously, you need enough cash for runway to achieve those milestones. So you want to make sure you're raising enough capital to prove that out. And if you're in a sector where fundraising is a bit more difficult, then I would maybe push for trying to get to profitability more quickly.
Perfect. And with that, we are going to round up on the Q&A session for today's webinar. It's been an amazing session. Thank you all for engaging so much. I think the questions were what we needed to hear. I'm sure the investors have been content with the type of questions that you've asked. Let's go back to our poll. Do we have our results from our poll? Okay, there we have it. So by popular opinion, we asked, what do you think is a good time to engage investors? And we've had 50% of you saying that when you have good traction. And then we had 42% saying immediately after you have a minimum viable product. Very few people thought that there should be some other reason. And then we had when you're ready to scale coming third, and bootstrapping no longer helping coming fourth. Okay. So what do you think about this poll, Ashwin and Lavanya, before we round up? Do you agree with the majority, have good traction before you decide to engage investors?
Lavanya, why don't you go first?
Yeah, not necessarily. I think it depends on what kind of funds you need to achieve your goals, right? So if you can bootstrap in those early stages, great, because then you're not diluting yourself. But if you don't have that luxury, then start engaging investors at the beginning, but just be careful about how much you're raising and at what valuations. I think as more liquidity comes into the market, you're able to sell an idea or MVP to the right investors. So yeah, no need to wait unless you're extremely worried about dilution and you have the ability to bootstrap.
Okay, and Ashwin, what do you think?
So recently I was in touch with a startup in India which has never raised money, but just recently raised about $20 million on their campaign, right? Like they went from 0 to 20, and they were very simple. They were like, Ashwin, we never assumed in our life that we were always going to be bootstrapping. So what these founders actually did was they actually just kept in touch with founders from the get-go. Like they presented them just I think quarterly updates. Again, they didn't expect people to reply to them, nothing, but they did their job as founders to make sure that they're building relationships and keeping investors informed. And again, this company started in 2016, didn't raise any money. All the founders put in their own money. And in 2020, when these guys during COVID, they started sending out their updates, like basically like Target, Sequoia, everyone was like, so we're now interested in you, right? So in that case, what really happened was it wasn't about good traction, it wasn't about good thing, but it was literally about the right place and right time and actually the right relationship, right? Like these guys didn't expect anything from the investors. And I know a lot of founders get very upset with investors when they actually say no. So, but in that case over here, these guys always expected to say no. They always expected to be bootstrapping, but at the right place at the right time, they just went across and just raised $30 million, $20 million round, man. It's crazy. These guys are like, I've known these founders for the last like 10 years of my life. They were broke ass people who are now just enjoying a really, really comfortable life, building a great business.
You're on mute.
Oh, okay. Well, then I'm glad it was muted. I was saying that I'm so glad, based on actually your comment, that as a co-founder, as long as you get your company in order and you are doing what you are supposed to do, it is always possible to raise funds. Thank you everyone so much for engaging with us. Special thanks to Lavanya for making time to talk to us. Co-founders, it's not always easy for them to get one-on-one with investors like yourself, so very much appreciated. Ashwin, as always, you are always down for startup co-founders. That's been evident since I was at MEST. Thank you so much for doing what you do. I hope you're enjoying in India, and special thanks to MEST for hosting this series. I think that we should definitely do more of this series, and I'm sure it will be coming up soon. For everyone who was able to join, thank you for joining. Thank you for your amazing questions. My name is Amishadayofori. I'm working with Innovation Spark, and we connect startup co-founders to investors like Lavanya and Ashwin. So definitely look me up as well. Follow MEST definitely if you aren't already on LinkedIn, Twitter, Facebook, MEST Africa on all platforms. Lavanya is also available, I hope, on LinkedIn. You can check it out, and Ashwin as well. Okay, with that, I'd like us to conclude here. This has been day 3 of the MEST Africa webinar series, Africa Startup Funding 101. Today was Ask an Investor, and we spoke with Lavanya Anand from VestedWorld and Ashwin Ravichandran, who is Managing Director at MEST. My name is Amishadayofori. Thank you all so much. I think that we can do a bit of networking till the Fast Lady sings. Thank you.
Thanks, everyone.